Hello, and welcome to the next installment of Fordham Real Estate Institute's Visionary Series CCL, bringing together the most influential minds in real estate. I'm Neil Madsen. I'm a member of Fordham Real Estate Institute's Executive Advisory Council and an adjunct faculty member. I'm excited to have you with us today as we ask key capital providers to show us the money. I'm also excited to tell you about our Scholarship 250 Fund, which we've launched in conjunction with this series. We're committed to raising $250,000 by 2026 with a goal of $250,000 every year thereafter, earmarked for scholarships and programming for deserving students from New York City and its suburbs who are interested in pursuing a career in the real estate industry. The Fordham Real Estate Institute will provide programs for high school students to learn more about careers in commercial real estate, and also provide high school and college graduates with the opportunity to obtain a professional certificate, a bachelor's degree, or a master's degree in real estate, construction, or development through Fordham's Real Estate Institute. We hope you'll help us level the playing field and invest in our future leaders by donating to this worthwhile cause. If you haven't done so already, you can donate by visiting fordham.edu/scholarship250. We'll put that link in the chat box to make it easy. It's my honor to introduce today's moderator, Tony Feynman, who's with ACOR, where he's responsible for originating, underwriting, structuring, and closing commercial real estate financing transactions, and for managing originations for the East and Midwest regions of the US. Prior positions include time at Brickman, Hillcrest Finance, and Wachovia Bank, where he managed, structured, and closed more than $25 billion of complex commercial real estate finance transactions. Welcome, Tony.
Hey, so is it my turn? Okay. I'm gonna quickly introduce our first three panelists today, and then we'll jump into our discussion. Kevin Davis is a senior managing director at JLL and heads JLL's hotel investment banking business, where he is responsible for raising debt and equity and structured equity. In this role, Kevin works closely with the lending community, including banks, life companies, debt funds, mezzanine providers, and CMBS lenders. He also works with institutional and other owners of commercial real estate, primarily in the hospitality space. More recently, Kevin's been involved in a number of hotel loan sales, UCC foreclosures, preferred equity, and rescue and recapitalizations of deals. Prior to JLL, Kevin spent 13 years as a lender with stints at Merrill Lynch and UBS. Kathy Courton founded Hillcrest Finance, where you may have heard I worked before. She was my boss, in 2013, and serves as its chief executive officer and chief investment officer. Kathy has over 30 years of experience in the real estate industry, primarily focused on debt investing. Hillcrest is a middle market investor in commercial real estate debt with over $500 million in assets under management through institutional separate accounts and closed-end funds. Prior to Hillcrest, Kathy was a partner and co-owner of Brickman, where she was also my boss, a New York City-based real estate equity and debt investment management firm. And there's a theme here because prior to Brickman, Kathy was my boss at Nomura Asset Capital Corporation. So we're done. That's the one time Kathy's been my boss. Michael Medvin, our last panelist, has over 35 years of experience in commercial real estate, having spent the last 24 years at AIG, with the last 22 years as a lender. Michael is currently the head of commercial mortgage loan originations for the US and Canada, investing between $3.5 and $7 billion per year in commercial mortgages. Over the course of Michael's career, he has financed, developed, leased, bought, sold, and worked out billions and billions of dollars worth of commercial real estate. So regardless of the question, you will have an answer, right? Okay, good. Okay, so I'm actually gonna go direct to I'm gonna go to Kevin first with a pretty broad question to start off our conversation. Kevin, what's going on in the hospitality sector today, generally, across the country, and then specifically in New York? And then afterwards, Kathy and Mike, if you would jump in with your point of view on the space and whether you're investing in hospitality today.
All right, great. Thanks, Tony. Appreciate the opportunity to be here. So I would say big picture, owners are certainly experiencing a fair amount of dislocation at the property level, given the fact that a lot of people are not traveling and the mask requirements and quarantine requirements Owners are certainly feeling it on the chin. The sectors that have performed better than others have been primarily drive to leisure resorts. Last summer, as you saw the economy opening up, people traveled, particularly if they could do so in a socially distant and safe manner. So people went to beaches and other resorts that were less dense, where they could actually spread out and vacation with friends and family. And so I would say that sub-asset class within hospitality has performed relatively well. The select service and extended stay sector has also performed relatively well compared to hospitality more broadly. I'd say that the subsectors that have been more challenged, frankly, have been the large group boxes that typically cater to group meetings and conventions. Clearly, there have not been many of those. So those types of hotels, particularly large city center hotels that cater to group, those have certainly suffered. Some of hotels, certainly in urban markets, like in New York City, for example, where tourism has dropped pretty dramatically. Many hotels in New York City have suffered. And then generally hotels that cater to business transient travelers. So people like me and most of the folks on this panel, we get on planes and we go out, we see clients, we have meetings, we attend pitches, et cetera. People aren't really doing that in earnest. And as a result, hotels that cater to those types of travelers are fairly challenged. So that's where things stand on the ground right now. I will say that we're certainly starting to see things improve pretty dramatically, particularly for hotels that cater to the leisure transient traveler. As we get into the warmer weather, the spring season, people are now starting to plan trips, starting to take trips. So as we talk to our owner clients, they're certainly starting to see pretty meaningful improvement in advance bookings, which bodes well for the industry. Away from the fundamentals, though, the other thing that's really interesting is, look, if you rewind 12 months ago, everyone would have said, wow, there's going to be a tremendous amount of distress in hospitality, which is a logical conclusion. Interestingly, there hasn't really been that much distress. We've certainly seen some loans that have sold at discounts to par. We've seen selective situations with distress, but there hasn't been a lot. And I think that's one of the things that's been a bit surprising to participants in the capital markets, that there hasn't been that much distress. And then to answer the last question, and then I'll be quiet. Look, New York City is facing a number of unique challenges, ranging from the fall off of demand. We were facing with a pretty meaningful supply issue, as in a new supply of hotel rooms that had started to come online in the city and had been coming online in the city over the past couple of years. That new supply continues to be delivered. There was stuff that, there were, I think, 10,000 keys in the pipeline to be delivered when COVID hit. So you're starting to see some of that additional supply get delivered. You also have a pretty heavy cost structure in New York City, particularly union hotels, property taxes, et cetera. So the combination of those factors, fall off in demand, new supply, high operating expenses, has created particular challenges in New York City. And I think New York is a market that we expect there to be perhaps a slightly more protracted recovery as a result of some of those issues previously identified.
Kathy, how about your perspective? Are you lending in the space today? And you could say anything else you want about it.
Yep. We like the opportunities we're seeing in hospitality. I think breaking it up similarly to the way Kevin did, think about the real estate fundamentals, quite challenging across the board, with some sectors performing better than others. But we both have to look at real estate fundamentals and then also where the capital is. And there's just a lot less competition in the space. So we can get what we think are very attractive risk-adjusted returns on first mortgages right now. We're also looking at mezzanine and preferred equity and recap opportunities, not seeing anything we love at this point, but that was kind of what happened over the course of the last year with first mortgages, where there wasn't a lot of transaction activity or a realization, let's say, or capitulation of value. And that there's more investment sales that are happening now and more first mortgage opportunities that we're seeing there. So just as a frame of reference, we're doing 65% loan to value with cash in front of us. So that's the value, at around 6 or 7% for our life company separate account, which is strong. We think risk adjusted return if we're right on that value. I think to the other part of the equation in terms of the distress is I don't think we've seen distress like we saw it last time around in terms of wholesale portfolios, but there's been a lot of recaps across the board. So I think it's a different type of distress in a different way that people are acting. But we like the space. We'll continue to invest as those opportunities unfold through the course of the next couple of years.
Mike?
Yeah, so I don't think anything Kathy or Kevin said was controversial, and I align behind them. So now I'm going to say something that may be a little controversial. I think the volatility and stress over the last 12 months as a result of COVID has to have an impact on the cap rate investors utilize when they're analyzing lodging assets. Multifamily, industrial, to a large extent, office have obviously held up better from a cash flow perspective because of sticky leases, where we literally saw these hotels shut down, board up, and struggle to carry their own operating costs. So, anybody who's seriously looking at lodging investments, if they don't adjust their cap rates accordingly. Now, I'm not saying that'll be in place for 10 years, but certainly within the next 3 to 5 year investment horizon, I think any investor is going to have to be more focused on that high beta cash flow. I do share Kevin's sentiments on New York. It was coming into the COVID crisis with a oversupply and operational issues with union contracts that put a lot of cash flow under pressure in the New York market. And we've got one asset in our portfolio that has succumbed to that pressure. Interestingly enough, though, we came into the pandemic with probably 12% of our mortgage book exposed to lodging, and we did have forbearance requests, but a lot of these assets were performing extremely well prior to COVID. We had assets on our book with 15-20% debt yields prior to COVID. We had sponsorship with deep pockets and capital to support their assets. Not saying we didn't give some relief, we did, but overall the lodging portfolio and on our balance sheet has performed quite well. But one asset in particular in New York is under severe stress right now, and they've been closed. They had issues with their commercial component. They've had issues with their union contract. So all the stresses that we've seen on Manhattan lodging is manifesting itself in this particular asset.
Do you guys think that?
Yeah.
Finish, Mike. I was going to ask a question after.
But we were active on 2 lodging transactions in 2020, and one was a recast of a loan in our portfolio. The other one was a newly originated levered loan. And what we saw between June of 2020 and December of 2020 was a lot more capital coming in interested in lodging, and we did see pricing and spreads compressed during that period of time.
Hey, Mike, I can tell you, I can certainly agree with that. I mean, we were taking bids on assets in the fall, and I would tell you that we probably saw spreads come in 150 basis points from the summer. And they've continued to come in primarily from the debt funds. The bank pricing has come in a little bit, but I mean, I saw debt fund pricing last summer north of 650, 700. Some guys had 8 handle. And then toward the end of the fall, we were getting 5-handle and 6-handle pricing on stuff that was, like I said, 150 to 200 wide, several
I
months
think
prior.
there's a lot of interest in the sub debt space where
Yeah.
they're still striking for double-digit levered returns. The insurance companies have been slow to come back to buy those A notes, but it appears that there's a lot more interest now from the institutional investors.
Isn't that how, I mean, that what you just described is typically the scenario, right? Is that the A note buyer kind of comes back in after the sub debt tries to take advantage of the situation, and then
After all the value's been wrung out of the trade.
Yeah, exactly. Kathy, you had a question you were going to follow up with. Yeah.
I was going to ask what these guys thought about when we were talking about New York hotels. I know a lot of the stock, or a lot of hotels have closed from the surface of it permanently, but do we think that will be permanent, or is that or do you see these, especially these larger hotels like that the Times Square, 6th Avenue hotels, will they be gone forever?
Yeah, my personal view is that it's a temporary closure on the part of some hotels. Look, I think there will be pressure. When I say pressure, market pressure to potentially convert some assets to alternative use. And that'll happen if it makes economic sense. If the cost of conversion relative to where you can value as multi, value as affordable housing, value as for sale residential, if it makes sense, it will happen. But I think for a lot of these properties, given the high fixed costs, they may stay closed, and the lack of demand, they may stay closed in the near term. But as soon as you start to see a pickup in demand, and as soon as there's any meaningful compression of rate in New York City, I think you're going to see what would arguably be shadow supply in the near term reopen as hotel when it makes economic sense to do so. Because for some of those properties, that is, hotel is still the highest and best use and will continue to be the highest and best use. So long-winded way of saying, some may say they're closing permanently. I don't quite buy that. I think they'll be closed as long as it makes economic sense. But once it makes economic sense to reopen, I think you'll see a lot of those properties reopen as hotels.
We did some robust research in the third quarter of 2020 on the Manhattan lodging market. Our research showed about 4,000 rooms coming out of service as a result of COVID. Some temporary, some permanent. And that is not a net reduction in supply, because there is WIP, there's product under construction now that will come online over the next 18 months. But overall, we saw the lodging inventory in Manhattan contract moving forward.
But
Yeah,
but I mean, not to play devil's advocate, but that research is based on assumptions about travel to New York, about business travel. What I guess my question is, and it was leading to my next question, which is that a year ago, no one was ever going to stay in a hotel again, right? I mean, I mean, the world was freaking out. No one was ever going to stay in a hotel again. It was going to take 6 years for the world to return, right? And you and Kevin, you and I have talked about this a lot. 6 months ago, people were starting to dip their toe into the water in terms of acquiring and buying hotels.
Yes.
Right. So it feels to me like the return to normalcy, or the path that we're on to return to normalcy, has accelerated significantly. So talk a little bit about who's lending in the hotel space today. Now, I don't mean individuals, but I mean like
right.
The numbers, what terms look like. Because it feels to me like it's accelerating rapidly.
Before you go there, look, we've been tracking all the major brokerage and research firms' forward forecasts on all sectors, including lodging. And everyone, quarter over quarter, everyone has revised their forecasts upwards.
Exactly.
So, as expected, the forecasters were wrong and are being proven wrong. I've still seen very conservative forward-looking forecasts coming out of the likes of JLL. No disrespect, Kevin. I think that those forecasts are still muted and are too pessimistic based on what we saw coming out of 2009 and the recession. where the lodging really did look back pretty dramatically.
Yeah, I guess the only thing I'll say in defense of JLL, I don't know that we've actually made any forecasts because we don't believe they're worth the paper they're written on.
It was one of your
What's that?
It was one of your national competitors. I apologize.
Oh, okay. Yeah, no, look, we have, and it's important to say that because I think it underscores your point, which is a good point. Nobody really knows. Okay, so we've been careful about what we issue from a research perspective, but I think going back to the original question that Tony posed, look, Tony, it's interesting. There's been a major disconnect between the fundamentals, which is where we started our discussion, and where the capital markets are. The capital markets, and when I say capital markets, I mean more broadly, the capital markets are treating COVID like a non-recurring event from an accounting perspective. If you have a merger and there's a big charge and it adversely affects your earnings, the CFO will tell the street to disregard it because it's a non-recurring event. And I will tell you that we're actually seeing buyers of hotels effectively treat COVID as a non-recurring event. Does that mean that there's no post-COVID discount? Not necessarily, but certainly the discounts are not to the same degree that people would have expected. And I think, Mike, going to your point about, cap rates should expand, arguably, yes. And they have expanded a bit, but also remember, treasuries rallied pretty significantly. So, you think of the spread, it's not just the absolute cap rate, but it's also the spread to treasuries, right? Which is that's compensating you for the risk. So I think there has been some marginal cap rate expansion, but there's also an inordinate amount of capital on the sidelines, which is driving pricing such that if you rewind to 8 months ago, 9 months, 12 months ago now, when we talked to buyers and asked, what will it take for you to buy a hotel? And almost to a person, they said, I need a 25 to 30+% discount. If you ask buyers today, what's the discount? Let's start with a luxury trophy asset. It might be 0. It might be a 5% discount. It might be a 5% premium because there's not a lot of that product on the market. For a generic hotel asset, what's the discount? Is it 10%? Is it 15%? Maybe, but it's certainly not 25 or 30%. So that's how the equity markets have treated COVID. And look, a lot would tell you that perhaps you missed the trade. We're starting to see so much optimism. We're starting to see improved forward bookings, which I indicated previously, and people are leaning into the recovery. They're leaning into a view that things will get much better, much more quickly. That is also compounded by the fact that we're starting to see pretty material improvement in the debt markets on a daily basis. So again, Tony, back to the original question, where are we? Banks are getting back into lending. The depth of the bank lender pool right now is not as great as I'd like it to be, but I'd say it's somewhere in the, call it mid 300s spread pricing at the low end to call it mid 400s pricing. Again, not as much liquidity there as I'd like. We're also starting to see the life insurance companies selectively quoting. Haven't seen that a lot. My sense of where they're quoting based on the couple of bids that we've gotten is generally somewhere in the 400 L plus or T plus for hospitality product, generally in the sub 60%. The banks are generally 55% or lower. The deepest pool of liquidity right now are the debt funds. And they are generally pricing as low as L plus 400, low 400s for 65%. And they'll go up to 70, 75%. And in some cases, for the higher leverage stuff, they're quoting that in the high 4s and low 5s. Now, there's certainly a lot of debt fund lenders that are quoting in the high 5s and 6s, et cetera. But that just gives you sort of a range as to where I'm seeing the market now from a debt perspective.
So I'm just I want to shift to another topic because I want to take the whole thing up with the hospitality space. But
You got it.
But I think which really suggests what you said earlier, which is that the predictions are going to likely be wrong, and they're impossible to rely upon, because the bottom line is the numbers that you're saying 400 over was 700 or 800 over 6 months ago, 9 months ago, and
100%.
that's a massive and aggressive change. And I think, and you could just feel it. I mean, the market just feels way more optimistic about the future, which is why, I mean, it'll be interesting to see whether business travel and even conferences come back way quicker than people anticipated. So, okay, I want to switch gears for a second. So, with all the talk about about the change in the way that we work and the change in the way and people working from home or partially working from home and more companies seemingly coming out and announcing that they're going to have a flexible work environment, and maybe that's to negotiate leases better, but so I'm going to direct this to Mike first. How are you looking at office opportunities these days? What do you think the future of office is in general, and specifically New York City, which obviously is a unique place and has some unique, I guess, challenges?
Yeah, that's a question that's top of everyone's mind. Most balance sheet lenders have the majority of their portfolio exposed to office product, right? That's the big assets. That's where you get your bang for your buck. And so this question of what's the future demand for office space has been looming large in everyone's shop. I think there's two camps that I'm hearing. It's too early to tell who's going to be right. So one camp is flexible work hours, work from home work. We can reduce our footprint by 20 to 35%. And why are we taking on these lease obligations? So that's one side of the coin. The other side of the coin is, I want to get my staff back to the office. We need the personal interaction. We're going to lower our density. We don't need 180 square foot per employee. We need 220 square foot per employee. And, to operate our intellectual business, we need to bring people together. With regard to New York specifically, and the opportunities that we're seeing, there's a lot of what I'll call commodity product in New York City. You walk down, mid-block, midtown, some of those Class B office buildings from the 1930s, 40s. If one of them disappeared in the morning, no one would even notice. But the demand for higher quality product, higher, amenitized product, I don't see that going away. And I don't see occupiers in New York industries such as finance, legal, now emerging tech and TAMI, having their workforce be at home. There's too much synergy bringing people together. It's a model that we're very ingrained in, and I don't see the habit changing.
Has your thought on that changed in the last year? Did that position evolve?
I remember conversations after 9/11 where people weren't going to come back to work in cities, where people weren't going to take office space above the 10th floor of a tower. That faded into memory relatively quickly. I have evolved, obviously, in my conversations with developers and deals that I'm underwriting. There is leasing activity, there is showing, there is interest in space, and the rents are not low. And the terms are not short. People are making 10 and 15-year commitments at rents that are 10, 15% inside of headline rents in 2019.
So, Kathy, what do you think? Are you lending money on spec office today?
No, I think it's really challenged from the perspective of I do see more tenants going shorter. I think that's both because people don't know how they're going to office coming out of the pandemic, but also I do think the shorter term will continue to be a trend which started pre-pandemic for not A space necessarily, but that B class of space. And what happens there is that because you're going to have to recycle space every 2, 3, 4 years, the math doesn't necessarily work. If you have to put in TIs of $100 a foot, pay leasing commissions, I think that's very challenging asset class. So I think some of the trends are going to be shorter term for that B space. I think that the secondary cities will likely benefit where people can get because there will be more remote working or distant working or ability to be outside of that home office. So we're definitely looking at deals in Raleigh, Miami, maybe that's not a secondary city, Austin, in office. I looked at a recap opportunity in New York not too long ago on an asset that would have traded at $700-800 a foot easy pre-COVID. And the going in basis was in the 300s, and we didn't feel it worked just because of all of the capital requirements. So I find office more of a question mark than hospitality, frankly, just in terms of the way people are going to work coming out of the pandemic. But we are looking at certain markets that we think will be beneficiaries.
Tony, just picking up on Kathy's point, look, we're certainly seeing investors in our space sort of bet on the thesis which Kathy laid out, which is that, look, while offices will continue to be viable and there's real value in having people come together, which I personally believe, people will have a lot more flexibility as to where they work. And so a lot of our investors are focused on southern Sunbelt markets with a lower cost of living, with good airlift, where people can theoretically, work there a week a month, 2 weeks a month, 3 days a week, fly back to a New York or Washington or Chicago or what have you. So I think our investors are assuming that workers will have a lot more flexibility. Interestingly, we're working on a transaction. It's a high-end second home community that has a hotel component, and we're in the process of taking it out for sale. We took it to a small preempt group of investors, and ultimately it never made it to market. We actually had foreign capital come in, acquire the asset, and the underlying thesis is it's a resort community where affluent resort community where people that have choices as to where they work, they'll live and they'll want to live. And so the investors are making that bet. So I just think it's really interesting, and certainly it's consistent with the theme that Kathy laid out.
I was actually speaking to someone last week who was making the prop for the benefit to the hotel industry of the fact that people are going to be working in more secondary locations and have to house themselves temporarily.
Yeah, no, look, I agree. Not to bring this back to hospitality, but I think it's an interesting point. There's been a lot of people in our industry are concerned, again, about business transient, but there's the discussion about the leisure traveler, which is the blending of business and leisure. The way I describe it is, look, X business trips, I'm generally chained to a desk in New York 5 days a week. And if I have the option to work from anywhere, then theoretically a hotel owner has an option to compete for my business 7 nights a week now, because I don't have to be at a desk in New York. I can be at a desk in Miami or LA or Chicago. So I think there's a compelling argument to be made that as people have more mobility, greater mobility has always been good for hospitality. So I could certainly see this being a boon for the industry.
Well, I know we're running short on time. To Kathy's point, we're engaged on a transaction in Lower Manhattan, Class B plus office building, unique attributes. Since June of 2020, they signed 7 leases with a WALT of 11 and a half years at rents that were about 8% off of 2019 clearing rents. So the building is well leased right now. So there's contradictory data out there.
Okay, so right. I mean, I don't know what the numbers are as of today, but let's just talk in the last few weeks. The utilization rate for Manhattan office is somewhere in the call it low to mid teens. Maybe it's crept up above 20%, but it's not. What's it getting back to? we're supposed to be predicting the future. And we're supposed to be saying where we're going to lend money. So
Oh.
presumably we're not lending money if it stays at 20%. So Kathy, what is it going to get back to?
I think New York and maybe a lot of places is ultimately it's a mark to market that for most asset classes, office, condominium sales, multifamily rents. If you bring the prices down enough, people will come. So, I would be very optimistic across the board on occupancy. But the question will be rents. People are opportunistic. To Mike's point, people are taking advantage of a reduction in rent to lock things in. So I feel like you'll get up there. I don't know if it's like 90% or 80%, but it'll be interesting to see where rents end up.
Well, Tony, I think you asked what was the utilization rate, not where you think overall occupancy settles. And the rough math for me is 80%, right? If people plan on working from home 1 day a week, then utilization should go back up to about 80%. I don't think I'll ever come back to Manhattan to work on a Friday again for the balance of my professional career. But that level of utilization rate, I see it potentially coming back very quickly once the vaccine rollout is more widespread. Broadway opens up, entertainment venues start to open up, people will come flooding back to Manhattan. I just don't see Manhattan go away. It's too important a city.
Yeah, well, and I think once the major employers start requiring people to come back to work, everybody will jump in the pool at the same time because they can't afford to be on the losing end of that.
Well, I don't think any major employer with a big balance sheet will require their employees to come back to work for fear of liability. But the MOFO or FOMO, fear of missing out, bring employees back. They don't want to miss out.
You're muted, Tony.
I know for some reason they keep muting me, I guess because of some feedback on Mike. But so who's back in the office right now of the three of you?
Nope.
I'm hybrid, but not today.
What does hybrid mean?
Prohibited.
Sometimes in, sometimes out.
Okay, so I'm gonna ask a leading question, but it feels like, and I think the themes that we've been talking a lot about the unknown of being able to predict, but we're supposed to be, hey, look, Ethan's there. We're supposed to be predicting, the flow of capital. So it feels to me like things have changed drastically in all asset classes in the last couple months, and the last couple weeks. So talk a little about that and why that's happening, Mike.
Oh, we're more bullish on lodging recovery than we are on retail. We saw retail, enter this cycle with a certain level of distress, and COVID has accelerated it. So, I prefer to allocate my capital lodging assets than retail assets today. Industrial and multifamily continue to be super hot, and they were all summer long and very difficult to compete on. And people are still poking around office in a similar fashion to the conversation we've just had now. There's clear views on both sides of what the future of office is going to look like. But what we're also seeing, which may be a tangent to your question, Tony, is some emergent asset classes that heretofore were considered more esoteric and are now gaining a lot of institutional interest. Life science and lab, data, cold storage, purpose-built single family for rent are all asset classes that were, on the margins and a little more fringy that are now really coming into focus as emergent classes.
I think everybody's.
Go, Kath.
Okay, I think everybody spent last year focused on their portfolio at the beginning of COVID, obviously. And, when the end of the year came and people realized that they still had runoff in their portfolio, they hadn't originated what their goals were for last year. I agree that there's kind of almost a 180 on, offensive versus defensive strategy, and across the board for banks, life cos, debt funds, you name it, people were focused on new products or new originations. But I also think that was very narrowly focused. So everybody wants industrial, multifamily, life science, and SFR, and office, hospitality, and retail are sort of more of a stepchild. Definitely competition, definitely capital out there, but everybody went after much of the institutional capital went after like very narrow part of the product type.
Agreed.
Okay, so we talked about this a little bit earlier, so I'm gonna bring it back up again, right? We talked about a ton of money was raised for the looming and massive distress that was going to be happening over the last year. At least from my perspective, and I think you guys all agree, we haven't seen it. So is it over? Or is there still distress on the horizon? Or is the crisis that we had as a result of the pandemic, is that behind us now? I know it's a pretty broad question, but Kevin, you go first.
Yeah, my view, Tony, is that this will play out over time. So I think it will be perhaps a more protracted recovery than we thought. I mean, the bottom line is, notwithstanding the fact that more people are getting vaccinated, notwithstanding the fact that more people are starting to travel and will travel in the hospitality space, there will continue to be adverse consequences at the property. I mean, depending on the city, we're not predicting a return to normalcy, at least in our valuations, not public research we're putting out, for another 2 to 3 years in certain markets. 2021 will likely be negative in a lot of markets, and 2022 may be slightly positive or negative. And so if you're an owner with a significant amount of debt and the inability to cover debt service, if you're not generating cash flow at the property, there will be issues. So I think the distress play will play out over time, but I think the most extreme examples, or the most extreme situations are past us. So why didn't it come to fruition? I think there are a couple of reasons. The first is there was a very swift response on the part of the federal government with the enactment of the CARES Act. Congress quickly got money into the hands of people and businesses, which helped forestall the worst of the crisis. The second thing that happened is, as it relates to regulated financial institutions, the regulators allowed the banks to provide forbearance relief and didn't force lenders to quickly start to exercise their remedies against borrowers. And so lenders were able to give some relief to their borrowers with the explicit approval of their regulators. You saw the same thing happening with non-regulated institutions such as debt funds. I think at the end of the day, the enormity of the crisis was such that if all lenders exercised their rights and remedies, I mean, we would have had a massive mark to market with everybody heading to the exit at the same time. And we all know what that does.
So basically what you're saying is that the lenders saved the world.
The Fed.
Tony, had you hired me last year?
Regulators.
No, but seriously, let's put it in stark contrast. Had you hired me last year to take your hotel portfolio, your book out for sale, we probably would have sold it at a 20 to 25% loss, which you would have underwritten, and
I'd be working for Kathy again.
Right, exactly. But that didn't happen. Were there sales where people took 10, 15, 20, 25% losses? Yes, but not to the degree expected. And so as a result, there wasn't everybody rushing to the exit. So the last thing I'll say, because I think it's relevant, I'm actually involved in a transaction where there was a deal that was cut last year for a variety of reasons at a low price for a variety of reasons. it's not going to get done, and it may come back out to market. And guess what? The value is going to be a lot higher.
Yeah.
So it's just it's really fascinating. So
That's why we waited, Kev.
That's why you waited.
Zero interest rates.
I'm
Zero
gonna
interest
ask
rates
both-
helps.
So Mike and Kathy, just jump. I mean, we're at the end, but just jump in real quick. What is there? Are we past the distress?
Personally, I think that the regulatory and the PPP money, as Kevin said, saved a lot of people. I still think there's a lot of values have gone down and balance sheets are in worse condition. And if there's staying power, there's not distress. And if there's not staying power, there is, and there will be. I don't think there's massive sales of loan portfolios, which I think most people consider distress, but there are still over leveraged assets and borrowers.
I think
Any wisdom to par us with?
I think you can't generalize. Commercial real estate is a lagging indicator, 18 to 24-month lagging indicator. We've seen equity markets recover. We had virtually zero interest rates for almost a year. I think it's property and market specific. I wouldn't generalize. I think that there's still uncertainty that has to be wrung out of the office market, and that's going to unfold over the next 12 to 24 months. I think that retail has a similar situation. I think all the institutional capital has underwritten through lodging, like they understand, I need a 24-month runway. I'm going to underwrite through that runway, but I have a prospect for a robust recovery. And multifamily just seems to keep moving along. We're not seeing the same type of NOI growth we saw pre-pandemic, but collections are up, occupancies are stable, and NOIs are flat. So I think there's growth going forward.
Well, thanks, everybody. We got a lot more to talk about, but we have to bring on the next group.
Thank you.
We'll see if they disagree with you guys. I'm going to ask them
It's a lot of
exact same
fun.
questions.
Thank you.
Thanks.
Can I hang on to see if they disagree? I may.
Hi, Tony.
Hey, Ethan, how you doing?
Doing well, thank you. How about yourself?
I'm doing well.
Well, this is a very.
So John's clearly working.
I'm in the
Yeah,
office.
but-
By the way, it's this new concept, work from work.
Hey, everybody. So I'm going to really quickly introduce the second panel so we can get going. So, hi, Greta. Greta Guggenheim has served as a CEO of TPG Real Estate Finance Trust since 2016. She is also a partner of TPG and serves as the chair of the investment committee. TPG is a New York Stock Exchange listed commercial mortgage real estate investment trust that originates commercial real estate mortgage loans in major markets throughout the U.S. And prior to TPG, Greta was a co-founder and chief investment officer of Ladder Capital. Ethan Penner, also a former boss of mine, there's been a lot of them on these calls, is a founder and managing partner of Mosaic Real Estate Investors. He serves as the functional chief investment officer of Mosaic and is a member of the investment and executive committees. Ethan has been involved in more than $30 billion of mortgage originations. He's a pioneer in the field of real estate finance with a 35-year career marked by filling voids and responding to unseen or poorly understood opportunities. Ethan is widely credited with being the primary driver in the creation of the CMBS market while at Nomura Securities. And finally, John Mechanic is the chairman of Fried Frank's extremely prominent real estate department. I added that, John.
Thank you, sir.
John counsels developers, owners, investors, real estate investment trusts, and lenders in all aspects of commercial real estate transaction. John has taught real estate transactions course at Harvard Law School for more than 10 years, and he also lectures regularly at NYU Law School, the Real Estate Board of New York, and the Practicing Law Institute. And John, all of us and everyone else on this panel are looking forward to hopefully coming back to your party at the end of this year. So
By the way,
please,
we're very excited.
please book the space.
We're very excited. I booked the space and I got my deposit down. I'm good to go.
Okay. I'm gonna throw out some questions. You guys can all. I'll try to direct it to somebody to start, and then obviously everybody jump in. So, I'm going to
By the way,
start with
with this
Greta.
group, Tony, I don't think you're gonna have an issue.
I
about
know,
jumping
I
in.
know. The hardest part for me is that they told me that I'm not allowed to give my opinion, which is really,
By the way, that's
that's
never
tough
been
for
the
me.
case.
So I'm going to start with Greta. Over the last couple of decades, there have been several crises that or events that have had a significant impact on our business, like 9/11, the Great Financial Crisis, even going back to maybe the Russian bond crisis, and several smaller ones in between. How has what we've experienced in the last year different? How's what we've experienced in the last year different than these past crises and events?
Well, I guess, can you hear me, by the way?
Yes.
Yes.
Okay. I think this one was clearly very abrupt. I mean, there was a supply shock due to the economic shutdowns of global economies and economies here in the US. It became a demand shock because people lost their jobs and therefore couldn't buy things. But the big difference was how quickly this snapped back. The government moved quickly. They learned a lot from the global financial crisis, even though the causes were different. That started with home prices and then with bank failures, and then spread over basically 2 years throughout the economy. This one happened extremely quickly, but the government, they dropped rates immediately. They did the CARES Act, as Kevin was talking about. They put money in people's hands, and the Fed did extreme monetary stimulus, and the government also did extreme federal stimulus as well. So rarely have you seen both monetary and fiscal stimulus be so extreme at the same time, and that's why everyone's so worried about inflation, because typically with just one or the other, you've had inflation, with the GFC being the lone exception. Also, post GFC, post GFC, the banks were out of the market. They were less out of the market this time. I mean, their box was narrowed, but they were still present. But more importantly, all of the non-banks that really were established and proliferated in the wake of the global financial crisis were, ready, willing, and able to supply capital during this most recent crisis. So I think I had what I was saying was that the proliferation of non-banks picked up the slack, and also. This time, as Kevin pointed out in the last panel, there was a strong encouragement for banks and other lenders to forbear, because we knew what the cause of the shock was, and there would be a cure for the vaccine ultimately, and if you could just make it through the worst of the pandemic, things would be better in a finite period of time.
Just whoever's orchestrating this, I just got a text from Tony saying, I just got kicked off and I don't know how to get back on. So,
Thank you.
the
We'll
three
get him
of
back
us
on.
are on, but we need Tony.
I would text him to use the link that he used before, but I don't, that
I'm
may
back
not be
on.
right.
We're okay for the moment. We lost our moderator. Our moderator is missing, but the three of us are here.
Yeah, so
I see
you're
him
in the
back.
office, John, right?
I am in the office.
And Ethan, are you traveling? Are you looking at properties?
I'm in Utah.
Oh, very nice.
How's the skiing?
Not yet.
Okay, stop catching up. I'm back. Lou Mirando said to blame it on
We
him.
tried to lose you, but apparently you're back.
Okay, Greta, you were talking, so you can
Yeah,
continue.
I think I've finished that. You can move on.
Okay, Ethan, why is this one different than all the other ones I've experienced with you?
I love the Passover question, Tony. It's a good one. I think that there's so many things you can say to pick and choose, and I want to be brief in answering that question. I think that number one, everyone has been looking for distressed since the RTC downturn, and they don't seem to understand that the lesson of the RTC period, the S&L crisis, was that when the government lets things go and doesn't support financial institutions and doesn't encourage financial institutions to kind of be patient, what happens is a gigantic wealth transfer at the expense of lenders for the most part and property owners, and it benefits a small group of opportunists and their investors. And they've made, the government learned from that RTC period. And I don't think we're going to see anything like that ever again. Certainly we haven't seen it. I think everyone expected it many times already. Certainly 08, 09, everyone was expecting a huge kind of rerun of the RTC crisis, and it didn't happen. It hasn't happened in the COVID period either. I just think the lesson was learned, and I don't think the government's going to allow that to occur. Now, having said that, because there's always the other side of the coin, if rates were to ever be right, the government is clearly has a huge vested interest in suppressing interest rates, and that's what's been going on for pretty much a decade right now. If that were to ever kind of slip past their control for whatever reason, and we had normalized interest rates, it would be the mother of all disaster and distress markets. And I think that there are a lot of people who I think are pretty smart who think that's very possible. I don't think that's possible, because I have a philosophy that I call the world won't end. And I think if that happens, we would be in a version of the world having ended. So I think everything in the government's power to avoid that from happening will be used to avoid that from happening. And so I don't think it's going to happen. But if it did happen, Tony, man, this would be the mother of distress, really bad.
John, anything you want to add?
No, I mean, I think as Greta said earlier, when it was in the beginning, when it was really crazy, I think lenders basically made the decision they were going to wait and see, that they were going to kick the can down the road by 90 or 180 days to let people have more visibility on what was going on, as people were out of their offices were shut down, and I think so that's come back in large part depending on the circumstance. Obviously, the retail industry is been impacted. It was impacted before. It just got worse. The hotel sector obviously got killed, albeit I think that people are kind of estimating those values and saying, that this next year is going to be better, and you can sell stuff based on 2022 numbers. So I think there's been a resurgence in those valuations. So there hasn't been quite the distress that people anticipated. I think on the other hand, kind of the B-class office buildings, those are the tenants where they weren't necessarily able to work from home in quite the same way. And I think those rent streams were interrupted. I think those, some of those loans and some of those owners are in trouble. And I think then you have to decide whether you have a vision or a path, or how you're going to repurpose those buildings, or how you're going to, in effect, reposition them to be attractive to tenants going forward as people come back to work.
So I want to go back to something that Ethan said. So, basically what you're saying is that the government is going to use everything in its power. What has primarily been in the government's power is to keep interest rates to a point where, to keep interest rates low enough, right? That's what we're saying. So there's got to be a long-term consequence of that, right? What's the impact that's going to have?
Well, if rates are suppressed, here's the thing. If rates are not suppressed at this point, all assets are priced to this level of interest rates, this level of multiples. The tech stocks and the empty buildings that John was talking about are being priced to a reasonably high level, because the opportunity cost is very low to put your money in a kind of zero dividend or zero earning investment, because interest rates are so low. So the alternative for money is so low. If interest rates were to go up, the multiples on cash flow earning assets would go down, proportionally, and the opportunity cost for sitting in tech stocks or empty buildings would become significantly greater. And as a result, the price would have to adjust accordingly. There would be, and then that's only on the investment side. The more profound punishment of higher interest rates would happen on the residential, single family, kind of every human being is going to find that they're deeply underwater overnight, as they did at the very beginning of that '08 great financial crisis. And the government stepped in and did what they had to do to kind of reflate home values, because that was the only source of wealth that anybody had. And once that was gone, everyone stopped spending, and it was the end of the economy. We're going to have that. I mean, so now everything got priced from, at that time, rates were in the, whatever they were, 3-4% on the 1 year, 3, they're 1.5%. And mortgage rates, houses are priced to a mortgage rate of 3.5%. And, it can't go higher. So I think that if it does, everything, it's a house of cards that falls down. And when you think about how could it be suppressed? Well, first of all, the Fed is the actor in the suppression, and the Fed will print money, and the Fed will continue to buy massive amounts of bonds. But the Fed also has regulatory supervisory authority over all the banks. And people haven't thought about that, but if the Fed decided to either force the banks to buy treasuries or reward them for buying treasuries by making a zero, like having no regulatory capital held against it. So in fact, infinite inflation, infinite leverage, and making it a very high yielding investment, even though because of the leverage, the Fed has great powers to turn our banking system into a repository for U.S. treasuries. And I would not be surprised if they did that, because if you go back to the 1940s, time around World War II, bank holdings of U.S. treasuries represent less than
Ethan,
2%
Ethan, you're breaking up a little bit, so I'm going to come back when I think you're moving probably, and it's causing a problem. So I want to jump to another topic real quick, and I actually want to ask John, because I'm sure you're seeing this. What are the lessons that have been learned during this pandemic that's going to change the way that we document loans? And we're supposed to be talking about the future. What are some of the big things that you're seeing that are going to change the way we close loans?
I mean, I think the issue of force majeure type of events, and what is a pandemic, and what does that mean in terms of, obviously I'm seeing a lot in leases, I'm seeing it in loans too, whether that gives you some hiatus in terms of the ability to accrue for a period of time, right? I mean, when people weren't collecting rents under a lease, people were out of the office. First there was a stay-at-home order, then the stay-at-home order was lifted, but people were nervous about coming back to the offices. People started coming back to the offices, but it's really only the vaccine rollout that has really, I think, increased people's visibility into coming back to the office and how the percentage of people back in the offices. So I think the issue is, sometimes there's like a general force majeure provision, whether that covers pandemics under insurance policies, whether think about the hotels and think about business interruption, and generally an exclusion for anything relating to the pandemic. And so I think people are going to realize that this is something that is not the thing that's never going to happen. It's something that can happen. And so people are dealing with it, and to the extent they can deal with it. For example, in the lease context, people are dealing with potential delays in the construction relating to delays arising out of the pandemic. But it's much easier to deal with that in the context of the definitive time to build out space and get into it, which is very different from what happens over the life of a 10-year lease. And if Greta were financing it, for example, And there was a provision that said, oh, well, the tenant has the right to an abatement in the event of a pandemic, and there was no limit to that. Then she's saying, well, how do I underwrite that? Right. If I'm financing, I've got great credit, but the tenant has the right to not pay rent for 30, 60, 90, 120, whatever days, arising out of a pandemic. I think that's very difficult to finance. So I think that for the most part, landlords are pushing back and saying, I'm not going to do it on a long-term basis. I can deal with the period where you're kind of building out the space and moving in, because that's kind of a discrete period. And I understand that and I can live with that. My lender can probably live with that. What I can't do is make that, a full-fledged, if there's a pandemic, your rent is excused. And I think that's why you're seeing, the bulk of the office buildings where, the tenants have, particularly the credit tenants, have continued to pay rent because they were obligated to pay rent, and they paid rent on an ongoing basis, subject to what the clause says. The clause obviously dictates what people's rights and obligations are. But I think people are thinking about that in a different way, and those things are being negotiated now in a way that they weren't prior to this. And Greta, what are you seeing on the financing side with when you underwrite leases? If you're making a loan on an office building, how do you treat if you see stuff coming in that's been negotiating today? What kinds of things are you seeing with respect to the pandemic?
Well, frankly, we haven't written any new office building loans post-pandemic, and the ones that we're seriously considering are long-term credit tenants. But we have not seen, we haven't seen any outs like that. But
Right.
You're absolutely right. The first thing we look at in the lease are what are the outs.
Right, because that's what you're underwriting, and that's why it's very hard for, even if you had an entrepreneurial lender who said, well, I think that's not, we figured this out now, I don't think that's going to be a risk going forward. They have to think not only for themselves, but when they go to Greta for their loan, they got to think, how is Greta going to look at it? And I might be willing to take that risk, but Greta's not going to take that risk. So if I want Greta to write my loan, I can't give this to the tenant, because if I do, I got no loan. So that's not
Hey, John, are landlords in New York City actually going that far and considering that, or they need to get tenants in there and their structure?
No, I think it's very hard to get that protection. Other than I think people are dealing with it in the construction context, because they view that as of limited duration. And also, I think we have visibility in that, it might have you might have felt differently about it in March than you do in this March, right? The world has evolved. And people are seeing vaccinations, and people, obviously, sites are working. So, giving that protection today is different from maybe giving it in June, right? When you just didn't know what the role was going to. But I think there's a very different view of giving it during the construction period and giving it during the life of the lease, because I think those are very different things. And you're looking about, I got a construction lender in place. They have visibility on what's going to happen over the next, 90, 120, 180 days. That's very different from, I have a 15-year lease term and something happens in the 8th year and the tenant's now going to stop paying rent. And also, how am I paying my debt service? Where's that coming from? So I think that is a much more difficult problem, and you're less likely to see that kind of concession from a landlord to a tenant, whether it's in New York, whether it's in DC, whether it's in California. I don't think it matters that much. The result, I think, is going to be the same.
I'll tell you, the biggest problem for me is that I usually push back on our internal lawyers by telling them, that's never going to happen. Right?
By the way, you might have said
the whole
that
that's never going to happen thing.
But you can't say that, right?
I know. So I said I have I'm screwed for at least another 3 or 4 years till everybody forgets what just happened. So, okay, yeah. I'm gonna change topics. So we talked in the last panel about the fact that no one was ever going to stay in a hotel again until a year later, everyone's staying in a hotel again. We talked about the fact that everyone's going to, work from home and no one's going to work in an office building again. And it seems like that, look at you.
By the way, you see where I am, right?
Right.
This is not a virtual screen. This is like the real deal. This is what an office looks like. This is a whole new concept. I was trying to explain it to Greta. It's called work from work.
I know, but I bet you if you took your camera and you walked around your office, it wouldn't be as crowded as it usually is. But
it would not be as crowded as it usually is, but it's more crowded today than it was yesterday.
No, I agree.
And it's more crowded yesterday than it was 2 weeks ago.
So that leads me to this question. So, and Ethan, if you can hear me, you can answer this question because I've known you for a really long time. you've always actually seemingly lived where you wanted to live and worked from there. Okay.
Anyway, I
so-
don't think that Ethan qualifies as your
I know, but
standard,
it was a good
standard
lead-in, John.
employee
John, it was a good-
or you're a work person.
It was a good lead-in. So, you know, there was so many articles about the fact, and this has been happening for a while, I guess, right? Alliance Bernstein moved to Nashville before the pandemic, right? But
By
there's
the
been
way,
so many
they only
articles
moved-
written.
They only moved part to Nashville.
I know, but hold on. So there's been so many articles that were written, especially in the early part of this, about the migration to out of these high tax states and you know, states that are, you know, why would you live in New York when you could live in you know, in Miami and work from Miami, right? And anecdotally, because I live down in South Florida, the housing market is on fire, right? But now there's starting to be articles where, oh, people are now going to move back, right? So I guess my question is, Ethan, is the migration out of these places like California, where you've lived for a good part of your career, in New York, Chicago, is the migration real? Is the migration real? And to what extent are we going to see that?
You know, I'm going to answer that question kind of in the same way that I think John presented a question to Greta from a lender's perspective. I think that the world today in real estate and actually in security stocks is a venture capital world rather than a value investment world, which means that there's very little in the way of certainty for cash flow. It's kind of why I love working class apartments, and I'm sure you do too, because there's at least some semblance of certainty around cash flow. Same thing with industrial, right? Anywhere there's some certainty around cash flow, these things are getting bid up like crazy because they're so scarce in today's world. And I think that the question you're asking is almost an existential question for a big part of the real estate industry. And no one really knows. I mean, you've got a few smart people on this call, including, you know, and me too. Okay. But the three of you are very smart. And I would just say that the industry is filled with smart people on the investment side, on every side. And the temptation is to try to answer that question because we're smart. I would think that the better thing to do, and I think I applaud what Greta said about not having made any loans on office since this, is to just say, you know, let's wait and see. What's the rush? You know what I mean? Like, this is a binary risk, and lenders don't really get rewarded for binary risk. It's the stupidest risk to ever take. And I think a lot of the real estate industry today, particularly office, CBD office, particularly retail, and even hotels to a certain extent, although I agree with what John said, they're less vulnerable. Many of them are less vulnerable than the other two sectors. But, you know, the office and retail sector is largely a binary risk bet today. And then lenders don't get rewarded for making binary risk bets.
The only thing I would say, Tony, we've done over the last 6 months, I would say, like billions of dollars of financings, particularly in the CMBS market, where you have long-term leases. I mean, it's the kind of stuff that Greta talked about underwriting, but we did the financing on 1 Manhattan West. It was like a $1.8 billion financing for Brookfield. They're all long-term leases with credit tenants, and there was a demand for that credit and for that product, so much so that the proceeds increased a couple of times during the course of the life of the negotiating the loan, and that it was oversubscribed. And then there was a subsequent financing on One New York Plaza. There was financing on the Grace Building. I mean, so, you know, in terms of underwriting office buildings, I think that clearly is continuing to happen. I think the issue is if you have a big roll that's coming in 12 or 24 months or 18 months, I think that's harder to underwrite, like what that rent's going to be and what's the timing to be to lease that up. And I think that's the situation. Maybe that's what Ethan's talking about, where, you know, the lender, you know, is probably going to take a more cautious view of what that is than they might have taken, you know, 15 months ago.
Right. And that all makes sense. But I guess what I'm saying is that I'm gonna I'm going to let Greta answer this as well, because I think she has a very personal answer to the question. But are people leaving and not coming back? I mean, I think the problem in our business is we always talk in absolutes, right? New York's dead, New York's not dead, right? Not everyone is leaving California, New York for greener and sunnier pastures, but is the migration of the population to other places than where they traditionally have lived, is that a real thing? And you're saying, I guess you're answering the question by saying it is a real thing, and as a result of it, or it might be a real thing, and so I'm not going to bet against it, right? That's what you're saying, Ethan, right?
I think that's right. And look, the other thing is everyone's trying to answer this question in an absolute sense, when in reality, you don't need to lose but 5% or so of your tenants to really have a repricing in your entire city. So to me, there's no question, Tony, that enough people are going to leave New York in this cycle and not come back to create a repricing of New York City office. There's no question in my mind. And I think that's true of other cities as well, San Francisco too. Whether that's a temporary move or permanent move, whether it's more than 5%, who knows? But it'd be foolish to believe that there wasn't enough movement that's come out of this that is permanent, at least semi-permanent, that will have a rippling effect on pricing, just because that's how pricing works. It's on the margin.
And I would add, Tony, that, I think you posed the question was, there was this migration, has it reversed? And I would say two things. First, there was migration out of New York prior to the pandemic. The employment and population numbers were declining. It certainly accelerated. But I think not, and then your question was, has that reversed? Because I think there was a couple of articles about maybe people are going back. I think not only is it not reversing, I think we've only seen the tip of the iceberg. And then I'll tell you just a couple of facts. I mean, first of all, 4 days ago, the New York State legislature proposed new taxes on top of taxes that are already there that increase the income taxes of corporations, individuals, and the death tax. Florida, Texas, a few other states have no state income tax and no estate tax. That's just one fact. The other fact is murders in New York City last year were up 45% and shooting victims were up 97%. Okay, that's another factor. And also, it was reported, I saw it in the journal, that 300,000 folks in high-income neighborhoods of New York City filed change of address with the post office for out-of-state residences. 5% of New York State residents pay 62% of the state income tax. I mean, the state and the city governments have to increase spending, and city services you can't expect Congress to bail out poorly run cities and states through a COVID bill, more than one time. I mean, yes, there's a lot of good things in the COVID bill, but it also stuck in there as a bailout for New York City and San Francisco and California's, poorly run governments to bail them out. I don't think that's going to continue to happen. And the budget in places like New York is going to continue to get worse. And if they're pushing people out, they're not just being neutral parties. They're pushing people away because they're saying that if you are an employer and you risk your capital to create a company, to create goods that people want and to employ our people, we're going to tax you more than you'll be taxed in other locales. Why would, as a new business owner, would you go there? And why, as someone who can work remotely, would you go there? And regarding the work from office, I would go so far to say that people that commute into the city aren't going to, pre-pandemic, aren't going to start commuting again. I think they're going to stay working from home as much as they can. Now, people who live in the city may go to the offices, but I just think there's so many factors. I agree with Ethan. I think the migration is real, and I think it's a phenomenon. I mean, in San Francisco, it's just crazy what they've done to businesses there. And I assume that's throughout California, but San Francisco is the starkest example.
So John, John, clearly
I would say that I'm not as fervent about it as my friend Greta, and I love Greta. And I guess I would say that I think that we who are residents of the city need to kind of focus on the mayoral race and the city council races, and we also need to deal with the state. I mean, there are clearly tax issues. This is clearly a high tax state as opposed to a low tax state, and we need to kind of make sure that people don't get carried away in terms of taxing away the people that really help support the whole economy and the tax structure. By the same token, there are extraordinary resources here, and there's an extraordinary concentration of very talented people in these CBDs, the New Yorks and San Francisco's and LA's and whatnot. And listen, last year, pre-COVID, but last year we signed a deal for 1.5 million square feet with Facebook in Hudson Yards. I was on the phone earlier today on a panel with the folks from Oxford who are building at the St. John's terminal, the new space for Google. We acquired Chelsea Market for Google. All of these, high-tech tenants, which people came here really for the talent pool, which wanted to be in New York. So, and those young people who wanted to be here. Now, obviously, that's been a challenge during the course of this last year. And there has been some migration to Miami and Nashville and whatnot. But when you look at the scope and the infrastructure of some of those cities as compared to what's here in New York, as to whether, I don't believe that all of New York City is now moving to Miami. I just don't believe that's the case.
I think that it's interesting, but first of all, I think what we can summarize is that you're probably staying for sure, which means you're going to be paying all of the taxes in New York. But okay, so
But you'll be able to call me when you need me here.
No. I think everybody would agree that New York's not going away. It's not going to become a ghost town, right? I think really the point is, I guess what Ethan and Greta are saying is that there's going to be a contraction of some kind. Do you believe there's going to be a contraction?
I don't think I have I think this may be the next year or so. Maybe, we'll see as people come back to the city and as the world kind of recreates itself. But I wouldn't count New York out. I think anytime people have done that, they've found that was a bad bet. So
yeah, I agree with that. I agree. You'd be unwise to bet against New York historically, but the paradigm right now has changed so dramatically, and I think certain habits are broken, and new habits are formed that I think it will affect it. But who knows, 5-10 years, maybe it's back to the way it was. I mean, it just feels like to me for the next 5 years, it's going to be.
I don't think it's that long. And I also talked to my people, and by the way, so I have one son who's in the opportunity fund business, and a daughter-in-law who works for a consulting firm, and both of them basically say, I can't wait to get back into the office. This work from home bullshit is like, I've had enough of it. I whether it's problems with connectivity, or the fact I don't see anybody, or how many that I live at my computer and I never get up because it's just the way to do it. And so I think that you see, and people, we are a community or a group that likes the collaboration, and you can do it on the screen, and it's better than having a phone call, and that's better than having an email. But there's nothing that I think is the same as kind of being in the same room with other people, and the casual kind of pick up and being able to exchange ideas. And I think people want that. And so, I think people have learned that you can do a lot from remotely and a lot from home. And it may be that Friday may not be the busiest day in the office, but I would say Friday probably wasn't the busiest day in the office beforehand, particularly during the summer. But that doesn't mean that people are going to be working at home from 5 days a week. I don't see that. I think people are going to return to the workplace. And I think, as the workplace gets more and more active, I think people are going to want to be there. I mean, it's very hard to have mentorship. It's very hard to learn from other people. It's very hard to have growth if you're doing it all from your apartment or your house in, 3 hours outside of New Or,
John,
you know, on Zoom.
I think that you're making an argument that honestly very few rational people would ever disagree with. I don't think you're not saying anything controversial. Every single human being would agree with what you're saying. I don't think that there's any question that the mentorship, the collaboration, the social aspect, that's going to be a draw, no question, for people to come back to work. It's not about will these office buildings be vacant or not. That's not really the question. The question is, has there been some marginal change, as I think Greta was hinting at, that may be sticky, right? Has patterns changed? And has this all happened at an interesting time when a younger generation, younger than your kids, that have grown up, because I have kids that are probably similar age to your kids, and I have kids that are
A
12.
lot of kids.
Right. I know that you try and cover every generation. So you've got, you've got
But
tier 1, tier 2, tier 3, and tier 4.
Younger kid, these younger
I do
kids,
too,
you know,
Ethan.
yeah, these younger kids, like, I mean, they'll have a party and sit in a house next to each other on a sofa and communicate with each other on the phone. Like, they won't look at each other when they're talking to each other. It's a bizarre thing. Okay, so when you think about why office, right? Office is a place where I love to go, and I think it's an amazing place for collaboration, for exchange of ideas, for mentoring and learning and growing. And I would never not go to the office. And I don't want to be surrounded by people who don't want to go to the office. However, it's an interesting thing because I'm not necessarily, and you're not necessarily, and Greta and certainly Tony are not normal. Okay.
By the way, thank you, Ethan. We all agree with that. And we all appreciate that we're all in the same boat.
And we probably like work more than most people, as you suggested about me earlier. And I know that's true for every one of us four. But, for a lot of people who either are in a more antisocial generation and haven't appreciated in their young lives the joy of looking at people when you talk to them and being with them when you talk to them, let alone even people that are older who just don't like their job that much, right? And so if they have an opportunity to not be there, which also means work less probably, okay? So the reality is there's a lot of less work going on for the people who don't like work, right? The people who we work with who love work are working their asses off at home, I have no doubt.
I agree with that.
But there's a bunch of people who don't like work, and this is a great opportunity to not work as much. Anyhow, so I just think when you cut through it all, you're right, John, but you're right for some portion of the population, and the portion of the population that's the marginal portion, that may be the one that drives a nail through a lot of coffins of owners and lenders of property.
Yeah.
By the way, that's
I would say, Tony, one thing, and I want to respond to Ethan. The only thing I would say is the people that you're talking about are the people who drive the industry. And I'm not telling you that there aren't people who would be happier working 30% less and working from home. But if the people who are driving the industry are back in the office and doing things, and they want the people that are working with them to do that, then you have something that's energizing those other people. And they might at the margin say, look, if my employer is indifferent as whether I'm there or not, and I don't really like my job anyway, and I'm just going to stay home, but they may not have a job in that circumstance. So if their choice is like having a job or not having a job, I think they're going to have the job.
Well, job reduction, by the way, and the shrinkage of quality jobs in America is something we haven't touched on, but it's also a reality that's coalescing with these other influences, like, interest rate risk is a big one, this kind of changing human behavior patterns and relocating issues, how companies expect employees to behave. And then on top of all of that, you've got technology aiming its gun right at the heads of all employees.
By the way, wait, I'm gonna sum it up because it's 2:00 and we're probably getting kicked off, but and
by the way, this only took 5 minutes. How can we be getting kicked off already?
What happened?
I said, it's only been going on for 5 minutes.
I know, exactly, but I guess maybe we're supposed to keep talking. I really have no idea.
no,
People
I'm just
told me,
kidding.
but what we basically just told the world is that all of these I won't say old, I'll just say very, very long-term people in the industry have there's so much uniqueness and so much change, both pre and post pandemic going on, that it's very, very hard to predict what's going to happen going forward. Right. That's really what we're saying. And I think no one is saying anything absolute, right? New York's not going to 0, but it might not go back to 100, right? Everyone's not moving to Florida, but a couple percent might, right? And that's it's going to be interesting time. So,
but Tony, there's
yes.
one other thing, and I'll be
Yes.
brief, is that many health professionals believe that COVID in some form or another is going to be with us for a very, very long time. It will evolve, and maybe it becomes like the flu, but there may be variants. Maybe we need booster shots. I don't think major corporations, certainly now, and if we find that COVID is with us in some form in the future, major employers are not going to require employees to go to the office. They're just not, and we've seen it already. They're saying, you even when our firms and other firms are back, sometime in, this year, I suspect that many firms will say, you have the option of coming back, the large ones. And if COVID stays with us in milder forms, which we all hope it goes away completely, but it's very possible it stays in some milder form like the flu has, that may persist into the indefinite future. I mean, that concept.
But if it persists the way the flu, no one was saying you don't have to come back to the office because there's a flu out.
Okay, right. Wait, I'm leaving us with one thing. I live in Boca Raton, Florida, and I'm going to call each one of you. What is COVID? I'm just
Is this
kidding.
a trick question?
We don't have that in Florida.
Oh, I see what you're saying.
By the way, you have a governor who doesn't believe you have it.
Oh, John. Everybody, thank you. See you all soon.
All right, guys. Stay safe.
Take care, everybody.